football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Hi. This week on Red Zone Retirement Program, John and I, Coach, let's talk about protecting what we need to protect, right? What you care about most, whatever that looks like. I don't know, you could call it a Memorial Day reminder. We're dropping this right after Memorial Day, right? So you're going to have some fun in the sun this summer. Make sure that you do have some protections in place. This ain't the sexiest stuff to talk about, John, but it's important, right?
It is, yes.
Yeah. So we'll get into a little bit of this, the financial side, I guess, of taking care of people that you love. And I guess I'll just start it here, like with life insurance to kind of kick it off, because it's a tough one for a lot of people when they get, all right, Memorial Day. It's the unofficial kickoff to summer. It is not actually summer, but we all treat it that way, right? Yes. 50 plus, right? We start thinking about retirement. We're not retired yet, but we start thinking about it. And a lot of people start getting into this place between 50 and 65, 70, where they're like, do I still need life insurance? Right? So where do you want to start there?
So I enjoy talking about insurance because I'm a nerd. I think that's one of those things where we develop a plan and then we fail to protect it. I mean, the whole point to doing a plan, and really, at the end of the day, insurance is actually really, really inexpensive leverage. It really is. We'll just go with straight life insurance.
Right.
You get $1 million of coverage if you're, call it around 55 or 60 years old. It costs you just a few $100s a year. And the payout would be $1 million if something bad happened to you. And I always tell people, insurance is legalized betting. That's what it is. You are betting that you're going to die, and the insurance company is betting that you're going to live. So those are the two sides of it. And they kind of, again, the actuaries, the nerds who figure out the numbers, take a look at you. They take a look at your health. They look at, the general numbers in society, and they figure out, okay, we're betting you're going to live till 78 or 82.
And I guess they want you to live because they don't want to pay out.
Correct. Yes. So that's what they're doing. They're betting. On the other hand, because you have, loved ones that you want to take care of.
Right.
We'll start with that. You want to make sure that if something bad happens to you, they're counting on your, retirement, your pension, future earnings, whatever it may be, paying off the house, paying off the student loans, parent loans, whatever it may be. You're saying, hey, I don't want to leave we'll talk about as a man leaving this to his spouse, or vice versa. If the spouse is your wife is a higher earner, it could be that way as well.
I mean, statistically, we die first, but either way, right?
Yes. So you want to make sure that your spouse is not saddled with unnecessary burdens that, they're kind of counting on, again, income or some sort of monetary benefit from your life because you're an earner. And that's what the insurance is for. So you want to make sure that people are protected. It's very, very easy because we're all, talking to you because you've been very unlucky lately, but we all look at this like we're immortal, like we're going to live forever.
Right.
And we all thought of that when we were 22 years old.
Yeah.
Hey,
and when you get over 50, you start realizing you're not, right?
And then by that time, it's a little more difficult to get insurance, but you can still get insurance when you're over 50. But the idea is that it's very easy to overlook. We get involved with our day-to-day lives. We're making our money. We're paying off our debt. We're saving for retirement. And you just get kind of bogged down. And I always tell people 3 weeks can turn into 6 months, can turn into 3 years in a blink of an eye. And you haven't had insurance. And what happens oftentimes is the whole point of insurance is, in case something, terrible happens, and it can happen randomly out of the blue. Again, you got hit by a hockey puck in your eye. Yeah. That's not something you were planning on. When you were driving to the game, you weren't saying, gee, I wonder if I might die tonight at the hockey game.
Interesting enough, the odds of that, by the way, are incredibly crazy. Like it's almost on par with getting hit by a bolt of lightning. So go figure. But,
so it's accidental.
It's accidental, right? I mean, all these different kinds of things happen. You just don't know what, you could get into the logistics of, what happens after that, but, accidents do happen, whatever, car, bus, whatever, walking down a street, whatever the case might be. So is it still relevant for a retiree? Because I think that's, okay.
Yes. So it can be relative in relation to a retiree because there may be the classic example we'll use is maybe, and when you're doing a Roth conversion, you can use some of the converting money to actually buy some future life insurance as well. And that it leaves your estate larger. One thing about life insurance, by the way, depending on how it's structured, but we'll say in general, life insurance is tax-free. which is kind of cool. So the payout, the benefit that you receive. So if you die and your wife receives a $1 million death benefit, that is tax-free benefit. So there's something powerful to that in the sense that we're looking for a tax-free retirement. This kind of fits into that calculation here.
That's a great point, John, because a lot of people we do hear lately, there's been a big push the last couple of years, retire, tax-free, and, insurance is a way to do that. And so people kind of think, well, okay, how does that work? Right. So there is a lot of buzz around that conversation and concept.
Yes. So there are some clients I work with IUL, Index Universal Life. So that is something that is very popular, and I do that with some of my clients. It has to fit in, people. This is not step A. This is usually step 6 or 7 in the process. But it's
from A to 6 or 7. You're good.
Yeah. Well, the first thing you're going to do is still max out your 401k. You're still going to do your IRAs or your backdoor Roth. So you're still going to do other things before you get to
the fundamental pillars, right?
Yes. But then there's going to be a point where, hey, I've done everything else I can, but I still have some extra room or a little bit extra runway, or have different goals. And Index Universal Life is a way to do that, where you can kind of you can kill several birds with one stone. You can get the insurance protection that, step A, which is you're going to have a death benefit, but you also can use this for long-term care. You can actually get an early payment for long-term care. And there's, again, some nuance and some rules behind it. And the third thing is it can actually be a supplement to your retirement, where if you build up the cash value, you pull the money out in the form of loans. Loans are tax-free. You have to kind of manage this and kind of let it live and breathe for a while. So if you start in your 50s or mid 50s and you let it sit for 10 or 15 years, by the time you get to RMD age or 70-ish, you can have literally 6 figures you're pulling out of this policy tax-free. If it's structured right. And that's something you can do. Again, it has to be part of an overall plan. So there's a reason why you can use life insurance in retirement, where you can kind of have all these things, where it's not just for death, a death benefit, but again, for long-term care. Great way to use it for long-term care.
Right.
And then also for a retirement plan. So those are things you can do with life insurance after retirement that is different than maybe what you need it for when you're 35 years old or 40 years old.
Yeah, because your needs change, everything's going to change. So in that same kind of vein of protection and that stuff, so not just life insurance, but let's talk about a very simple way to protect those loved ones, since that's kind of the theme today, is the simple beneficiary designations, right? This is the simplest, low-hangingest fruit, easiest, cheesiest thing you can do. And it's not just your life insurance policy. You do this make sure you get your 401ks and all your other things with BDs.
Yes. So as we're recording this, that is one of the exercises we're going through in my practice. Every couple of years, we do a deep dive into beneficiary designations. We send out a report to our clients, and we list every single account they have and who the beneficiaries of that account. And instead of saying a percentage, what we do is we actually put the dollar amount. So if you have a $1.5 million IRA, we kind of let you know that Smart Susie is getting half of that. So she's getting $750,000, and Lazy Larry is getting half of it, and he's getting $750,000 as well. So you see the dollar amounts there.
Poor Larry.
Poor Larry. But you see that who's getting what, and then it's in real dollar amounts. And so that kind of triggers people. Hey, maybe I need to adjust my beneficiaries. A quick story that I always tell people. I am in a remarriage. And my wife through her school district, has life insurance. She has, that's one of the benefits she has.
Right.
We were doing a double check a few years ago. We've been married now almost 20 years, mind you.
Mm-hmm.
We were doing a double check on her, through her benefits on her website. And we found out her ex-husband from many years ago was still the beneficiary of her life insurance. That was wild. And I always tell people, I'm in the business. And that was something that we were overlooking. And so we want to make sure we fix that ASAP. As we're going through this exercise with my client base, we've had several people go, oh, by the way, I did not realize this person was getting that, and they should not be. And it wasn't something where they're estranged. It was just a misallocation that they wanted to fix.
Yeah. I mean, there's, marriage changes, births, deaths, divorce, disabilities, whatever. There's different kind of triggers. Make sure you're just doing it. And again, it's low hanging fruit, John, right? So, I mean, it's just check it off. And to your point, little things can get missed, right?
And you can change things too. I have a client of mine that has changed her life insurance beneficiaries a couple times over the last 15 years. Just because their needs change, her desires change. And that's easy to do. It's easy to change your beneficiary designations as well.
Let's do the next one, estate documents. So, I talk about my mom often on here. She's in her mid 80s, right? I kind of use her as a great example. It's, I'm in my 50s. I'm entering in that, retirement stage. She's well into it. And so she brings that to me the other day with things going on. She's like, I wonder if the will that your dad and I made 50 years ago is still good. And I'm like, Nah, probably not, Mom. Plus, he's been dead for like 30. So there's probably some right? So estate documents, right? You got to
Yes.
update these things. You also got to make sure you have all the important stuff there, right? Powers of attorney and so on and so forth.
Yes, you want to have the healthcare directive. You want to make sure you have the durable power of attorney. You want to have the will, which just kind of says who's going to get what. You want to have all these things put together. We don't practice law. We in our practice, but we will review this on your behalf, and we'll kind of tell you, hey, by the way, go to whoever it is that prepared your trust. Or a lot of times, I have people that have a pretty decent chunk of money and have no plan. They don't have a will or a trust, and so that's kind of scary as well. And it's not because people are lazy. People just get super busy. Even in retirement, people get busy.
Well, John, and it's not who wants to plan their death or talk about their death. It's not a fun topic. I get it, right? But it's like you also, when stuff comes out of the blue, you also kind of go, crap, I maybe better do this, you know?
Yeah, my wife hates talking about it. I talk about it very matter-of-factly. It's like, hey, this is what our plan is, and this is what we're doing. And she goes, I hate it when you bring this up all the time. I hate when you talk about
I have flirted with it too many times I'm very cavalier about it. And many people are that way, but other people, like, they're scared to death. It's like, hey, it's a jinx. If I talk about it, it's going to happen. But you got to do the stuff and knock it out, right? So that you can at least feel a little better, you know?
Yeah, you just, again, be open about it. Be very matter of fact, because you don't want to find out this stuff after the fact, because we've all heard the stories. We've all kind of experienced it in some ways, where a loved one has passed away, and we're scrambling to find out, where's the life insurance policy? What are the passwords, to
that's a good
their
one.
accounts and stuff like that. So we want to have that out in the open, so that if something happens, by the way, what's the percentage of people that are going to die?
Pretty much all of us. Yeah.
100%. Yeah.
We're all checking out of the hotel at some point.
Yes. So it's something that you just have to know. And so this, and again, we don't know at what age that they're going to come, we're going to get the knock on the door and say, by the way, it's your time.
Right.
So you want to have this prepared ahead of time. It's nothing weird. It's good to do. And especially good to do not only with your spouse, but with your kids.
You made a good point I want to wrap up with. And, look, the statistics are what they are. Typically, us guys die first. Typically, there's whatever stereotype you want to add to it. It exists for a reason. But a lot of people also in a relationship, one person is really good at something. The other person is like, I don't care about it. Maybe they can do it. Maybe they don't want to do it, whatever. But having somebody you can turn to, no matter who passes first, is a great piece as well, because you can be like, look, because Murphy's Law is going to Murphy's Law. If you're the one doing all the financial stuff, you're the one that's going first, probably most likely, right?
Probably, yes.
And the other person who could care less about it is going to be left, emotionally distraught, obviously, and then holding the financial proverbial bag going, now what do I do? Mm-hmm. So having somebody, look, call John in this event, here's a binder. I'm sure you guys put all that kind of stuff together for people.
Mm-hmm. Yeah, so that's exactly it. And I've had numerous clients say, let their children know or their spouse know your first phone call is going to be to John. That's certain. The first thing that you should do is reach out to us. We keep all this stuff tracked. We know where all your accounts are. We can't actually have passwords to your accounts. That's one of those little no-nos that we're not allowed to have. But we do tell people, make sure you have that, written down. And so there's a little handy dandy checklist we give people. Again, we go through this every couple of years to make sure the spouse knows where everything is and the kids know where everything is. And again, we have what their wishes are, how they want to be buried, all that stuff. Just
you got guidance. You've got guidance. Yeah.
Yes. So we take care of all that. And your advisor should be the first person or one of the first people that you contact to kind of get you through this tough time if something does happen.
For sure. Well, I got a double reference here as we wrap it up, Coach, because you're a football guy as well. And we were talking about you're also a nerd. And so at the time we're taping this, shout out and rest in peace to Donald Gibb, who played Ogre in Revenge of the Nerds, who just passed away a few days ago at the time we were taking this. Great role. He was fantastic as Ogre in that movie. So
it's a great classic movie.
Yeah, classic for sure. So rest in peace to him. So we will get off of here today, Coach. Thanks for hanging out. As always, if you got questions, you need help about this boring, not so sexy, but incredibly important topic, please reach out to qualified professionals, have a conversation. Of course, John is here to help. We'll have all the links in the show descriptions down below. And that way you can click on it and get some time on the calendar with him and have a chat. And I got to let him go because he's actually going to do that right now with a client. So we're going to get out of here. Have a great day. We'll see you next time here on Red Zone Retirement Program, Simple Investing, Smart Future. Click that like, subscribe, thumbs up, all that good stuff so you catch new episodes when they come out. Coach, see you next time.
Thank you. See you, Mark.
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by RescueMyRetirement.net. That's RescueMyRetirement.net. Fill in the basic info and he'll ship those out to you immediately. That's RescueMyRetirement.net for a copy of Diffuse and Tax-Free Retirement in California.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.